Hello, everybody, and welcome back to a special session of Anatomy of a Trade. Today, Sensei Roman and I are going to look at a trade that was done on the intraday time frame by a student in the WTC2 spring class, Eric, in the crude oil futures. And it's going to be an interesting session here to take a look at with Roman. So, hello, Roman.
Well, hi, Franz. It's good to be here. It's good to be back on the anatomy of the trade. Looking forward to this session.
All right. Well, let's jump in and take a look at Eric's trade. But before we do that, we have some things that I know you want to go over. So over to you.
All right. Well, we want to invite you guys for the complimentary 2 sessions of Wyckoff Trading course. As usual, at the beginning of each semester, we open door to everyone who wants to come for the first class. So the complimentary WTC1 session is going to be conducted on August 28th at 3 p.m. Pacific. You could register on our website. And the complimentary WTC2 session, the practicum, the semester is going to start on August 29th at 3 p.m. Pacific. And also it is an open door session. You are welcome to come, to visit, to listen, to watch, ask questions, reach out after this session, sign up, become a part of the class, become the part of the student body. And really quickly, what is it that we're going to study in WTC1? So WTC1 part 1 is all about analysis. How do we create the foundation for our analysis, a sound analysis when we look at the chart? We're going to tackle the Wyckoff price structural analysis first. This is where we're going to concentrate on the changes of behavior, changes of environment, Wyckoff phases and Wyckoff events. And then we're going to transition into the volume and price analysis, and specifically, the most important Wyckoff law of effort versus result, bar by bar analysis, which is basically a volume and spread analysis, VSA, swing by swing analysis, and the analogs. Then relative and comparative analysis for a couple of sessions, where we're going to show you some of the proprietary things that I've developed personally. And then we'll talk about the tactics and trade management. So 15 sessions, very intense course. Each week is the homework for you on your knowledge and some skill development. Usually students that come out of these 15 sessions, they report that their ability to read the chart has improved dramatically. So that's what we want to give you from those sessions. This is how we want you to improve. We don't say that you're going to be making millions of dollars. No, that's step number 20 or 100. First, you just need to be able to soundly analyze the chart. And then WTC2, part 2, the practicum, as we call it, it's all about building the skill. So if we build the knowledge in part 1, then in part 2, we build the skill, and we train people to become very, very advanced chart traders and advanced traders as well. So what are we going to discuss there? The significant bar analysis with elements of VSA, but goes into a big depth of the significant bar and significant bar tests and the changes of behavior just based on that. Swing analysis, we're going to concentrate on the cumulative effort and cumulative result for any swings, and we're going to bring up the work of David Weiss a lot. And then something proprietary that we've developed here at Wyckoff Analytics, sequential bias analysis, flashcard analysis, quantifiable sequential bias analysis. Those are the ways that we've developed as to how to dissect the bias of the trading range. And this is an extremely important exercise, not only from theoretical point of view, but also from the point of view of the homeworks that you guys are going to do. And you're going to have 2 homeworks, the bias game, the weekly bias game, which I'm sure you already playing either on our Twitter at Wyckoff Analysis or on our website at wyckoffanalytics.com. And that develops and trains your mind to acquire the skill of how you look at the trading range and how you look at the chart and how you decipher the bias. And then anatomy of the trade is an exercise on awareness of who you are as a trader right now. What are your weaknesses and what are your strengths? And we get to that point through post-analyzing your trades, all of them. So each week you will have those 2 assignments. Those are very, very crucial. We've been doing this. I mean, I've been doing this for, I don't know, this is going to be semester number 40 or something like that. So you can imagine it's been a while. And in all of my teaching experience, these 2 exercises are the best, for different reasons. And look at this, Franz has this beautiful testimonial for us for why he's taking the WTC2 for the 13th time, Franz.
Completed number 13 and probably will be back for number 14, Roman.
Oh my goodness. Okay. All right. Well, let's not even go into this. You could just stop the recording and read Francis' testimonial, but I think just this one phrase, I have taken WTC2 class for the 13th time. That just like there is a reason why Franz does it. So let's definitely listen to him as he finds so much value in this. All right, Franz, shall we go to the trade?
Let's take a look at the trade, Roman. You want me to kick it off here?
Absolutely.
Okay. Well, the first thing we want to look at is just kind of an overview, and we're looking at a trade in the crude oil futures. We're looking at a short-term time horizon, showing here the 1 hour chart, and the intention is a swing trade. So that being said, let's take a look at the background that Eric was looking at coming into the setup for this trade. And going from the left of the chart to the right, let's put a Wyckoff story together. So the first thing we always want to look at is what is the background? And we see here that we're coming in from the left in an uptrend. And we see that if we look at the volume signature, there's some climactic looking, an increase in demand. We see the range or the spread of the bars going into the area of resistance or support that Eric has delineated with the horizontal blue line. But we see, first of all, one really good spread on the breakout bar, and notice how significant the breakout is. If we look at and all the way back to, I guess it would be the very first day, if we look at that breakout and we look at the importance of that significant bar, which Roman alluded to when he was talking about WTC2, we have good extension, and we come up into this area where there's a little bit of a loss of momentum in the overnight session, and then we see some continuation and a decline, as Roman has indicated, in volume. That's probably tells us that we're maybe running into a little bit of area here where we could see the this uptrend potentially going into some sort of change of behavior. So do we see a change of behavior? Well, on the 1 hour chart, I think we do see a change of behavior with the area that Roman is highlighting there, and that tells us that that's going to set some sort of a trading range situation up for us. So the next thing we want to do is see what happens during the trading range, and we see that we move up back to the top of the trading range in the overnight session, and there's not really very much going on here. We're hugging the resistance of the trading range, which is actually a good sign. But then going into Thursday, we see that there's a break. There's an attempt in the bar that Roman has circled there, where we're trying to go up, and notice the volume signature. It's somewhat weak, and we just don't make any further. There's no extension. There's no ability to follow through. And then we get a break, and the break is pretty significant. It looks like there's definitely some supply coming in. We can see that from the volume signature. So the next thing we want to do is what is this supply achieving? What's the result? And what happens is on the last supply bar where the volume's the strongest, we try to break down through support, and immediately we see a very, very strong reversal. And how do we know that that's a reversal? We'll just simply look at the range, look at the spread, look at the position of the close, look at the attempt to go lower, and yet there's no ability. And immediately there's a reversal, and it puts us into a spring position. So this is where Eric is entering the trade, and I've been doing too much talking. They don't want to listen to me anyway, Roman. They want to hear you. So I'm going to turn it over to you and let you give your input into Eric's trade itself.
Mm-hmm. Well, I mean, you just went, there are a lot of great stuff that you've mentioned. So just want to maybe reiterate certain points here. So we're definitely seeing that, diminishing thrusts, right? So the breakouts are becoming less and less. This bar is trying to break out. This area also is trying to break out, and we're seeing shortening of the thrust in both cases. So there are the preconditions to change. And then we need to see what kind of change that's going to produce. Okay, another observation here on the change of behavior. So the initial move down is not that damaging, right? So if this is the last climactic run, what do we see? It doesn't retrace all the way on this first initial swing down. Then swing up, so we have, let's say, like buying climax, automatic rally, secondary test. This defines the trading range. Here's our trading range. Then in phase B, we're starting to see, some weakness. Okay, so this is a minor sign of weakness. Please note how, first of all, it's an intraday time frame. So you are going to have those spikes where maybe the tails are going to go into the zone where you might think that this is a weakness. But I think one of the advices here that I could give is look at the close, because the close and the intraday are going to be a little bit more important than just the tails. So look at how both closes come back above the support. So they're still in the trading range. So we're labeling this as a minor sign of weakness in phase B. Ability to hold in phase B in the upper part, even though this is all after the market, is strength. So we're still thinking that in phase A, there is no violation. In phase B, there's no big violation except maybe for the tails here, but they recovered really quick. So we're still thinking reaccumulation here. So when the price starts to go down, we're saying that in the bullish background, we are observing a decline and a change of behavior. Could this change of behavior be negated right away for the continuation of the reaccumulation range? And as Franz has described, yeah, we're definitely seeing an increase of the supply. There could be a trade here somewhere if we're on the intraday level, but that's not our intention. Our intention is to swing trade. And this recovery right away, I mean, like as Franz has described, much better bullish spread and bar. Only one close below the support, on immediate recovery on the next bar. That's what spring is about. And point of entry right away, Franz, I think is pretty clever here. I wonder if it was opened actually on the 1 hour, or did Eric go to maybe like a lower time frame, maybe like 5 minutes, and opened it there? But why, one way or another, we are in a good position here. I think that maybe on the lower time frame, the point of entry was why, because of the stop loss number one. So, Franz, I'm not sure about the placement of the stop loss. Well, what are your thoughts here?
Yeah, I mean, typically we want to place the stop loss below the lowest area of the reaction, certainly when in a test. So in a spring, I should say rather. And in the middle of the trading range, maybe I think Eric, got lucky because we didn't get after that big down, those 4 bars, 5 bars to the downside, there could have been a more significant test that could have come back a little bit deeper. And by being this sort of aggressive with his test, he could have been, I mean, I think he might have lucked out a little bit here and not got stopped out. So
I think he probably opened it on the lower time frame, this point of entry, maybe like on 5 or 15 minutes. And that's why the stop loss is also being placed on that time frame. So that we don't see that level specifically, but there probably was some kind of level. Also, I'm kind of thinking here, what about like 1/2 of the spread and then placing the stop loss slightly below that, because this spread is expanding so much. So yeah, that makes a lot of logic as well. But whatever the reasoning is for the stop loss, we're not getting hit. Right away, we have some kind of continuation. The aftermarket hours are non-eventful, so there's nothing going on there. But I also want to kind of commend Eric here on this technique. This is stated as a swing trade. So the intention was not an intraday open and close during the session. The intention was to go overnight and to keep up building the profits if the trend is going to continue. And I am extremely surprised that on the first futures trade by Eric, this is done as a technique. I mean, obviously, if you've done this before somewhere like on stocks, on cryptos, somewhere else, you could definitely know, you already know the mechanics of it. So this switch from the intraday to the swing technique that we study in WTC2. I'm sorry, in some intraday and swing workshops. But yeah, executed really well. So what do we see next? Event, right? So the oil output is cut by Russia, and that produces that big spike. So right away on this type of spike, your trading decision is always going to be, do I close it now? Do I trim? Do I stay and do nothing in anticipation of the continuation? Is this too quick to the overbought condition, overthrown? And then what does the structure say? So, Franz, what are your thoughts on this bar, on that particular bar? Not what comes even next, but on that particular bar. What would be your trading decision there?
Well, let's compare that bar to every other bar that we can see on the chart. And it's at least twice. So there's bound to be somebody out there, and probably more than somebody, that's saying, this is way above the mean of whatever we should be seeing here. And there's going to be some shorting almost guaranteed to come in. So my decision, especially if I was thinking of a swing, I'd want to get out at the sort of the apex of the swing, the top part of the swing. I'd be thinking that with this much kind of move away from the mean, that this would be a good place to exit, probably, you know, at the high and certainly on the next bar. So,
yeah, one of the things
thinking
about these bars is, we always mention analogs, right? So this is an expansion bar. This is a breakout bar. And look at when it happened before. Okay, expansion bar, something like this. What happens afterwards? At least for 2 bars, you have some kind of movement to the upside. How about this attempt to break out? Even not expanding too much, but still, this is an attempt to break out. What happens afterwards? Couple of bars afterwards, right? This was the weakest breakout attempt, and yet we're still trying to go up on the next bar. How about here? Breakout, next 2 bars. Breakout, then look at what happens next. So I would start assuming that we are definitely in some kind of short-term overbought condition where a mean reversion trade is going to come. So you start thinking, okay, where potentially the target is for this mean reversion trade. Well, one thing that we could do is we could think about the structure. What is the structure? We said that this is our trading range right here, around this level, around 78.5, 79. And what we've just seen is probably could be interpreted as a sign of strength. What comes after the sign of strength? A backup action. It could be a trading range. It could be just one reaction. But where would it come? It would come back to the support which acted before as the resistance. And there is a confluence here. That particular point of support is 1/2 of this big spread, somewhat close. So that's probably going to be our target, that we are going to come back to this area around 78.5. So where we are at the close of this bar, this is the decision process that you have to go through. First, you know that there might be some small extension to the upside, and you could squeeze out efficiency on your profits, on your unrealized profits. That's number one. The second decision here is if we know that the target, potential target, that is, it's not necessarily that it's going to happen. At that point, we're thinking this is a potential target for the mean reversion trade. If this is the target, are you willing to give up on the intraday trade or a short-term swing trade about $2? Slightly less, but still a big chunk of your profits. It's almost like 50% of your profits.
Right.
So is there efficiency there? How could we be efficient here? So I see that the decision that Eric has made was, no, I don't want to give up that much. So my stop loss number 3 is going to get me out of the position really quick. So somewhere here at around 79.5. So please note that we're still losing some efficiency here in terms of how we exit in the price. So we're going to deal with this in a second. And then the second stop loss could have been the thought of like, well, this is too strong. So could we possibly continue with this trade and maybe develop it into a much longer time frame? I think that the first logic about stop loss number 3 is not sound. And I think that the stop loss number 2 is sound, but executed incorrectly. So let's just dive into this. Why is the logic on stop loss number 3 is sound, but executed incorrectly? Because if we want to be most efficient with unrealized gains that we have created, we want to move the stop loss faster and more aggressive in the overbought condition. One of the techniques that you could have here is just to continue trailing the stop loss with the lows or 1/2 on those big bars stop losses, right? So don't put it after the change of behavior bar. Put it right away after you had this close. You know there's going to be some kind of attempt to go up. Put it under the low here. So that's number one. Number two, once you go into the hourly chart right here, go to the lower time frame and become more aggressive with your stop loss. Meaning that, let's say like on the 5-minute time frame, find your exit. And with that, your exit is going to be more efficient. You're going to exit somewhere here. Not the difference. This is almost like what, 60 cents. This is where we lose efficiency, and this is where we're pushing our advanced students, to think about those things of how to be more efficient, creating more money. And once you become that efficient and you start accumulating that, efficiency, kind of like profitability, this makes all of the difference, in your P&L. So if this is the first way to deal with this is the second way, then what would be the third way to deal with this? After the change of behavior bar, where basically like, okay, that's it. We're going into the reaction. We're in the mean reversion trade right now. What do? I want to get out at the best price. The next bar is an attempt to rally. So again, use this technique going to the lower time frame on the bar that is attempting to rally, and exit on the lower time frame, let's say 5 minutes. So you're going to be maybe slightly below 80, but you're still not going to be closing at 79.5, right? So your efficiency is less than, let's say, this exit right here, but still it's going to be close to like the close of the actual climactic bar. By the way, one of the things here was the climactic bar is you could just partially close there. That would be another scenario. So 4 scenarios for you there. And then let's come back to stop loss number 2. So if our thinking here is that maybe long term we're gonna, recover, maybe we're gonna hit 79. I would be thinking slightly below it. But let's say like if we would have this type of the scenario, our stop loss is not hit. So this would be our long-term swing campaign developing, and we're going to go into another day and see if the structure and the supply and demand are going to allow us to continue going up. Why was it executed? Why is it such a good thought, but the execution was incorrect? Well, I mean, extending the profit, staying in the trend is always a great thought. Plus, if you're taking some profits in this area right here, holding a part of the position longer with anticipation of the continuation with the background, which is bullish, I think is very logical. But would you want to put the stop loss so close to around 1/2 point? I'm assuming it's somewhere here. Would probably be thinking, let's put the stop loss somewhere slightly below, like in the 1/3 of the actual, big spread, right? Something like this, somewhere slightly below. Another way of thinking about this is you could look at the previous areas of the support and resistance. You could look at the areas of the breakdown. Where did this happen? This was a very important point, which created this resistance, and then this kind of like a little bit localized breakout. So you could still think that stop loss should be reflecting maybe like this area right here. I know it's a little bit far away, but at least you are broke even on your entry or slightly profitable, and you're allowing the price to consolidate after a very volatile event. So after such volatility, you're going to have a very sharp reaction as a mean reversion trade. So you need to, for your longer swing campaign, be a little bit further away. Other than this, for the first trade in futures, France, I don't know. I want to have such a first trade in futures.
I agree. Great job, Eric. Yeah. One of the things that we talk about in our analysis is that after a backup action, we don't want to see price come back into the trading range. So that's sort of, where is the trading range? And that would be another kind of stop guideline that you might be thinking about. So if we get back into there, we're probably, probably going too far. We're probably, something's going on that we're not really expecting or anticipating. But I like the idea of trim, and maybe trim a lot, but still leave some cards on the table and see what happens going forward. Because remember, typically when we have a consolidation, it's going to continue in the same direction that it began from, which we saw all the way over on the left of the chart. And we can expect that the probability is that there will be, at least an attempt for this to continue, and maybe we want to stay around and see if there's additional profitability.
There's an interesting discussion of the size of the trim that could be head here on this chart. Why? Because of the character of this bar. Like the character of this bar defines that unfortunately you have to trim a little bit more here. Why? Because again, overbought condition that comes so suddenly, suggesting that the reaction is going to be, quite deep. It does not have to be bearish reaction. It could be a bullish reaction, but that the reaction itself, retracement, could be deeper. So with that, you start thinking about, what is my trim here? Should I trim more? Should I trim less? So if you are more long-term oriented as a campaigner, then you have to take less. So let's say like long-term swing campaign. You're gonna trim less. What's the logic here? Well, you look at the character, it's still bullish. You have the immediate background to the upside. You have a very bullish bar. So you have to trim less, I would say like maybe like 1/3, and then wait and see how the mean reversion trade is gonna unfold. If you're more of the short-term swing trader, then you're absolutely concerned about the efficiency that we've talked about. So then here you might be actually trimming more, let's say 2/3, and then you're keeping 1/3 for your longer campaign. And it seems to be like, well, does it really matter? It does, because the psychology of the campaign trader on the intraday swing time frame and the short-term swing trader, which is basically the intraday trading, are going to be completely different. You have to find the point of exit for the long-term campaign that is efficient, and this is not the most efficient place to get out, because we're just getting out of the structure. We just accidentally, behind the event, became extremely overbought. Whereas for the short-term trader, that overbought condition, that event created a unique opportunity to have more profits in a shorter time period. So you have to take more there. Franz, I'm not sure if, like, I hope that our viewers are following this thought process, but that's basically how I would be thinking here for two different types of traders.
Yeah, and I think the real lesson is know yourself. Know what it is, what's your
Who you are as
intention.
a trader.
Yep, exactly. Getting into the trade, what's your intention, and then be true to yourself.
Yeah. But other than this, Eric, really good trade, especially very impressive that this is the first trade. But we know how you like the swing trading. So thank you for showing and sharing this trade.
Great. Yep. Thanks, Eric. And thank you, Roman. Always great to have you on board. I mean, just to hear the input that you give and the analysis is just so beneficial. So thank you very much. And until
Absolutely.
next time, everybody.
Thank you, Franz, and thank you, everyone. Bye-bye.